Hey everyone, welcome back to Corporate Decoder. Today, TPG Private Markets Fund just filed an N-2 registration statement, and I am seeing some crucial details about how they plan to invest your money. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing gives us a rare peek into the fees and risks of a specific type of investment fund that most people never see. So TPG Private Markets Fund is basically a new fund. It was set up in Delaware and it is registered as a closed-end investment company. This means it is not a typical mutual fund where you can easily buy and sell shares every day. Their main goal is to make your money grow over the long term, which they call long-term capital appreciation. But it is super important to remember that this goal can be changed by the fund managers without even asking the shareholders. Now here is where it gets interesting. They plan to put at least 80% of their money into investments managed by TPG, which is a big global alternative asset manager. TPG has been around for a long time and manages a huge amount of money, over $300 billion as of the end of 2025. This means the fund is heavily relying on TPG's expertise. TPG's main focus is private equity, meaning they invest in companies that are not publicly traded on a stock exchange. They have a long history of investing in sectors like healthcare, technology, and consumer businesses. They are known for being hands-on investors, meaning they actively try to improve the companies they invest in to make them more valuable. The fund itself aims to give everyday investors access to these kinds of private equity investments, which usually have super high minimum investment amounts, like millions of dollars. TPG itself is not actually managing this fund directly, but iCapital Fund Advisors LLC is the investment advisor for this TPG Private Markets Fund. When you buy shares in this fund, there are different classes. For class of shares, there is a sales load, which is like a fee of up to 3.50%. This means if you invest $1,000, you might pay up to $35 in sales fees right off the bat. This is a pretty standard fee for certain types of investment products. Then you have class I shares, which do not have that sales load, but they often come with different ongoing fees. The fund pays iCapital Fund Advisors LLC a management fee of 0.35% annually. This is a fee for managing the fund's overall strategy and investments. This is a big one. The fund invests in other investment interests, and those investments have their own fees. The filing says these acquired fund fees and expenses are estimated at 1.17%. This means you are paying fees on top of fees, which can really eat into your returns over time. The document also mentions that these acquired fund fees can exclude something called carried interest, which is a share of profits that goes to the investment manager. If that carried interest is included, the expenses could be much higher. Then there are other expenses, which include things like operating costs for the fund. For Class A shares, these are around 1.39%, and for Class I shares, about 0.75%. These are the day-to-day costs of running the fund. When you add it all up, the total annual expenses for Class A shares are almost 4%, around 3.91%. For Class I shares, it is about 2.57%. This is quite high, especially considering you are already paying fees within the underlying investments. But here is a slight silver lining. The advisor has agreed to limit certain expenses until August 2027. They have a contract to cap what they call specified expenses at 0.28% for Class A and Class I shares. If the actual expenses go over this cap, the advisor will reimburse the fund. This helps to keep some of those costs in check, at least for a while. After this expense limitation agreement ends, these costs could go up. Let's look at an example on a $1,000 investment, assuming a 5% annual return. Class A shares would cost you about $62 in fees in the first year. Class I shares would cost around $21. Over 10 years, that difference really adds up. For Class A shares, that is $427 in fees, and for Class I shares, it is $287. That is a significant chunk of your potential returns. Now let's talk about the risks, and there are many. Investing in this fund is considered high risk because they are heavily invested in TPG. The fund is less diversified than a typical fund. If TPG makes bad investments, it will hurt this fund directly. The fund itself is also new and has a limited history, so it is hard to judge its past performance. The document also highlights the risk that there might not be enough good investment opportunities available. Competition is high, and there is no guarantee they will be able to invest all the money raised. A major risk is investing in private equity itself. These companies are not publicly traded, meaning they are less liquid, and it can be hard to sell them quickly. They are also often highly leveraged, meaning they use a lot of borrowed money, which magnifies both gains and losses. Valuing these private investments is also tricky. The fund relies on information from the investment managers, which might not always be accurate or up to date. This can lead to the fund's net asset value not perfectly reflecting the true value of its holdings. Crucially, these shares are not listed on any stock exchange. There is no ready market to sell them. Liquidity is only provided through repurchase offers by the fund, which are not guaranteed and can be limited. This means you might not be able to get your money out when you want it, making this a very long-term illiquid investment. The filing really hammers home the point about substantial fees and expenses. You pay fees directly to the fund, and then you indirectly pay fees to the underlying investment managers. This layering of fees can significantly reduce your overall returns. When new investors put money into the fund, it can dilute the stake of existing investors. If the new money is not invested wisely, it can negatively impact the returns for everyone. Like many companies today, the fund and its service providers are also exposed to cybersecurity risks. A breach could disrupt operations, lead to financial losses, and impact the ability to calculate the fund's value. There is also a whole section on tax risks. The fund aims to qualify as a regulated investment company, or RIC, to avoid certain taxes, but failing to meet the strict requirements could lead to significant tax liabilities at the fund level, which would ultimately hurt shareholders. The fund has no obligation to repurchase shares at any time. Even when they do offer repurchases, it is limited to 5% of the net asset value per quarter, and there is an early repurchase fee of 2% if you sell within a year. This reinforces the illiquid nature of this investment. In essence, this filing for TPG Private Markets Fund highlights a fund aiming to provide access to private equity for more investors. However, it comes with significant fees, high risks associated with private equity investments, and very limited liquidity. The heavy reliance on TPG and iCapital fund advisors means their success is deeply tied to the performance of these entities. The structure and fees suggest this is an investment for sophisticated investors who understand and can bear the risks of illiquidity and substantial expenses over a long time horizon. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hit like and subscribe for more insights. Links to our community in the description.